Yep.
Okay. Everybody, it is Wednesday, 9 o'clock. There's some technical difficulties, but we're here with you. So, as always, Investment Education Academy is going to introduce you to some material that can help your financial position. And this one will be definitely of interest to you because we're going to talk about interest rates. With that being said, I'm going to let Leon kind of give you the background of why we chose this today.
Yeah. So, one of IA's hallmarks, or something Brent and I always talk about, is we got to get our money out of interest-bearing accounts, things like checking accounts, savings accounts, and bonds, right? And and the reason is that because, like we always say, that those accounts are paying such low interest that your money's being eaten up by inflation literally daily. And so I want to show today, like, why, like, what's behind that actually, like, how does that work? Why are rates so low? What we're actually going to show today is that interest-bearing accounts have been horrible investments for 40 years, 40, since 1980. If your money has been in the interest-bearing account, bonds, checking account, savings account, it's been a horrific, just a train wreck of an investment. And I'll show you why. So Brent, can you throw up slide one?
Before we go to slide one, I just want to talk about, again, the emotion of investing, right? Because it's important for a lot of people to remember why we have these discussions, and especially in the manner that we do. It is very normal for most people to go with what they know. And what we've been taught year after year after year is that put your money somewhere safe, savings accounts, your 401k at work, under the bed, wherever. But we haven't really been taught the true methods that lead to success in money growth. We've really been learning practices of what is it called? The game is like we're just moving money around. We're not actually putting it in places where it's working for us, where our money becomes an employee. And so today we're going to talk about the fact that many of us have our money not working as an employee. Our money really has us just working as if it's the boss of us. And we're always trying to earn more because we're putting it in inferior places. And we talked about this during the segment about the wealth gap of the variance in interest rates that Black America gets from white America. And it's roughly 130 some percent. And so today you're going to understand why. If anybody is listening to this on our podcast, if you're watching us live, and right now that a lot of your money is in a savings account, is in a CD at the bank, is in a bond somewhere, or it's in some type of certificate of deposit, this is going to be information you want to listen to. This is a great episode, though I think a lot of them are, so I'm biased. But I think this is a great episode to share with your family, especially your parents. So if you guys know your parents get on from time to time, it'd probably be a really good idea for you to tag them, because the information that we're about to share about traditional savings platforms will be very enlightening, not only for them, but it will allow you all to have a conversation later on about, okay, so what are we doing as a family with our money? And for those of you all who have children, great opportunity for your kids to listen in, because they should grow up without some of the broken thoughts that we had as it relates to money and where we really are putting our money for growth. So let me pull up slide one.
So what slide one is, I'm gonna give a quick kind of history lesson and just kind of educate people on how interest rates even work, where they come from, why they are what they are. And the first slide Brent's gonna throw up is the way interest rates work, right? Everyone thinks they come from banks, right? Your bank sets your rate. And it's partly true, but it's not fully true, right? So what happens is the Federal Reserve sets what they call the Fed funds rate. And this is the rate that the basically banks use between themselves. So it's called overnight lending. I'm not going to go deep into it, but this is the rate that that banks use to lend between each other, right? So JP Morgan may lend to Wells Fargo, and there are a bunch of reasons why they do this. But just know that the Fed funds rate is the baseline rate that's set by the Fed. Now the next rate above this is called the prime rate. We'll show you that in a minute. But what I want you to look at here is, because this is the baseline rate. Hey, Brent, if you could, I see like yeah, there you go. So this is the baseline rate for all rates in the economy. Now you look at the chart. So the chart we're looking at here is showing the Fed funds rate from 1955 through 2017. And as we can see from the left side so from 1955 to about 1980, the Fed funds rate was actually rising, right? And that's great for us as savers, because that means what we were getting in our checking, savings, and like CDs was rising every year, right? So 1955, it was at about, 2%, and then shot all the way by 1980 up to about 16, 17%. So, which is great because, again, this is the baseline rate that all banks use. Then banks use this, then set their rates. So, but then you see from 1980 through basically today, I mean, this goes through 2017, but basically today, rates have dropped. Fed funds rate has dropped 98%. 98%. So what does that mean? What that means is that if your money has been sitting in an interest-bearing account for the past 40 years, on average, you're losing, as far as the return on your money, 2.5% per year, because this thing has dropped. The Fed funds rate, which is generally interest rates, has dropped 98% in 40 years. So you average that out, divide that by 40, and you get about 2.5% of negative returns on your rate per year. So again, that doesn't mean you're actually losing 2.5%. That just means the return that you're getting is dropping by 2.5% per year. Huge loss. I mean, and look at this chart. I mean, it's a precipitous, continuous drop since 1980. So again, if your money has been sitting in interest-bearing account, you've been getting essentially a negative 2.5% return for the past 40 years on average per year.
And when you all look at this rate of return, you're like, no, it's not negative. The same amount of money is still there. You have to remember, we're talking about the buying power of your dollars, right? And, sometimes we get that confused with money that we can see. The money that you can see, you have to think about the value behind the dollar. And, it's very easy just to think I have a dollar in my hand. It's never changed. No, that dollar hasn't changed, but how much that dollar can actually purchase has changed. And when we go through this, again, if you are the person with the savings account and you're like, my life savings is in there, you have to really give some strong consideration to what we're talking about as it relates to you. This is not telling anybody go out, liquidate your savings accounts, liquidate any certificates that you have. But these certificates lock you in for a certain amount of time. And so that amount of time, you lose what's called opportunity costs. And those are costs that relate to things like investing in the stock market, buying real estate, investing in shoes. So, Sneakers, I gotta say right. Well, I'm sure it's right, it's shoes. Anyway, so we laugh and we make it light, but we make it light so it's digestible, because we have to start to change our mindset around these things we call safe investments, because they're really not safe. They're just a very slow death. And because it's a slow death, we think it's okay, and it shouldn't be okay.
Yeah, not at all. So yeah, Brent, you go to slide 2. Now, what this is showing, this is the prime rate, the prime interest rate. So a lot of people may have heard of this.
And real quickly, for those who are listening to the podcast, we have a graph up, and it's just basically a graph with XY axis showing the interest rate in percentage points going up and the years on the X axis from 1950 to 2015.
Yep. So this is prime rate, right? So a lot of people who have gotten loans have heard, prime plus a number, like prime plus 3, prime plus 4. So what prime is, so again, prime is set by the banks, and they set prime based on the slide before this, which is the Fed funds rate. And the Fed fund rate, just real quick, the Fed fund rate isn't actually a rate. It's a range of rates. So like right now, the Fed has set the range between 0 to 0.25. That's the range the Fed funds rate is. Now, if you go to most banks today, the prime rate now I think is like 3.5%, because typically the prime rate is about 3.5% percentage points above the Fed funds rate. So with the Fed funds rate effectively being 0, prime is about 3 to 4%, just depends on the bank, but on average it's about 3%. So what this is showing here, and prime rate, so the prime rate is a rate that banks lend to their like gold standard customers, people with 810 credit scores, and typically businesses. So really, really, high credit worthy people. I mean, my credit's decent. I've never gotten a prime loan. When I get loans, they're usually prime plus a number, which I think most people are getting prime plus a number versus actually getting the prime rate. Again, the prime rate is typically for really high credit scores.
It's
And
normally
then
100 plus.
yeah, 800 plus. Yeah, yep. So this chart is showing kind of a similar thing. That remember, the prime rate is going to follow the Fed funds rate. So as the Fed raises the Fed funds rate, banks then raise the prime rate. So we see here from 1955 again to 1980, the prime rate went from, I don't know, 2-3% up to about 18%. And then, then we see again from 1980 on down through today, it has been again, on average, about a 98% drop in the prime rate. And again, the reason why this sucks is because people that are savers, savings account, checking accounts, CDs, your rates are typically based on prime. So as that rate has dropped precipitously over the last 40 years, again, on average, you were looking at a negative 2.5% return based on your return. So let's just say if your return, I mean, this is throwing numbers out there. If your return was like, your rate was like 100%, the next year you would be down to like 98%. And then next year you'd be down to like, 95%. So you'd be losing, you're not losing money in your account, but your return is dropping per year. So you're getting a negative, you're netting out a negative return per year. And that's not the way investing works. Investing, you're supposed to get the opposite, you're supposed to be getting higher returns per year. So again, yeah, if your money's been sitting in a interest-bearing account over the last 40 years, on average, you've been losing about 2.5% per year on your return. Now, this is what most of us know, savings account, right? And so this is 2010 through roughly, I think it's 2017, 18, just stay through today. Back in 2010, savings account rates on average were about, we'll just say 0.20%. Again, not even 1%, not even half of 1%. 0.2, is that 0.2? Yeah, 0.2%. And so we see since then, this also has dropped roughly 98%. It's gone from, we'll say 0.2% down to roughly, like I just checked this yesterday, the average savings account rate in America right now is what we have here, 0.05%.
Okay, and just for those who are like, okay, my head is spinning a little bit, it's a lot of numbers, I'm not tracking completely. Let's summarize some of this by saying, if this slide, and this is a show of interest rates in US banks, right? If you're getting somewhere in an area of 0.5% on your money, and this is 0.05% really, it'll take you over 114 years for your money to double. So if you all aren't understanding what this means, if this is you, and we can almost kind of do a mic drop right here, because this is the goal. If you have a bank account and you're putting most of your money in that savings account portion of your bank, because it could be multiple places, but right now, just for ease of assumption, we're saying savings account, and you're getting roughly 0.5%, let's say you're getting 0.5%. And that's a lot of America getting 0.5%. And that might actually be high for some banks. If you're getting 0.5%, it's taking your money over 114 years for it to double. And let's say you have a good bank, right? And you're getting like 1%. You're still talking about 72 years that it's going to take your money to double. And the rates don't look like they're going to change for the next 2-3 years. So let's really let's lock in for the long run of this. And now let's compare it to what's happening with this, not traditional inflation, but let's call it COVID inflation. We're talking about, bread and milk and goods that we need going up 7, 8, 9, 13% in some cases. I mean, it's people who just in manufacturing that buy eggs for cakes that they make, and cake makers all over the world are like, we're getting put out of business because eggs cost 7% more than when we started our companies. In some cases more. So if you have your money in these savings accounts and these traditional type of, I almost want to call them like, basically your money's hostage in these places, but you could take it out. We just don't know better, right? Like most of us don't know what else to do, and we don't trust the market. We're scared of the other places it can go. But look at the chart. And for anybody who's not watching, the chart is assuming, this says 0.05. So I'm going above the chart, and I'm saying if your bank is giving you a savings account at 0.5%, you're still looking at 114 years before your money doubles.
Yep. And like Brent said, this chart is showing 0.05%. Remember, that's per year. That's for a year. This isn't per month. This is saying you're getting 0.05% per year. So if you take that 0.05% and divide it by 12, per month, you're getting less than a penny or so, something per month. Like this,
less than a penny. It's
effectively, huh?
You're getting nothing.
You're getting nothing, right? You're effectively, I mean, we're almost, so just real quick, some countries right now in the world have what they call negative rates, right? So what that means is if your money's in the bank, every month, they're actually deducting money from these people's account to pay that negative rate. So the negative rate may be like 0.05, 0.1. So they owe that per month. We're very close to being at negative rates. Now, I don't see us getting there because I don't think the American public will support negative rates, but we're at effectively 0% return in savings accounts. This right here, the average is showing 0.05% per year on your money. And as Brent said, 0.05 will probably take like 200 years for your money to double or something ridiculous.
It's 320, something like that.
320 years for your money to double. And the main point of the show here was that Brent and I always say that having money in savings account is a terrible idea. Well, okay, I'll tell you that. Having investments in savings accounts is a bad idea. We get rainy day funds, we get emergency funds. If you have money there for that, cool. I mean, we all have that. But when it comes to investments and more long-term investments, having your money in these places is a total destruction of value, destruction of your money. And I want to make the point that the point of this was to show that, so yes, they're terrible investments now, but what we want to show is they've been terrible investments for 40 years. Interest rates are down 98% in 40 years. On average, you're losing 2.5% return on your money per year for the last 40 years. That's not how investing works. Investing's supposed to go the other way. It's supposed to be getting that 2.5% more return on your money. So we really want to make the point with this was that rates are low, rates are going to stay low, and anything with an interest-bearing account, checking savings accounts, have been horrible investments for over 40 years because, again, rates are down 98% over 40 years.
And this goes back to when we talk about it, and we're oftentimes saying, you have to look at where we're keeping our money, where we're putting our money. This is probably one of the most important lives we're doing right now. And it's because we're not talking about specific stock or a sector, but we're talking about where most of them, really the minorities in America keep their money. And it's killing us financially. It absolutely is killing us financially. So this is the one we hope that most people are listening to, but we also know this is the one where a lot of people are like, oh, this might not be the sexiest of content. This isn't a stock I can go buy tomorrow. This isn't a sector that's doing 153% rate of return. But this right here, for everyone who's listening to the podcast, who's watching this right now, this is where you're drowning. If your money is in these savings accounts, if your money is in these traditional investments, this is where the gap widens. And a whole point of Investing Education Academy is to narrow the wealth gap, not to widen it. So I beg you all to listen to this particular one and think about what it means to you. And if you don't understand, well, what can I do with my money? Well, I don't know about the stock market. I don't trust the stock market. It's never been something that's familiar. It doesn't necessarily have to just be the stock market. I mean, honestly, and this may sound funny to many of you all listening, you could probably make more reinvesting your money into a lemonade stand in your neighborhood than you'll make in your bank.
Right.
That's like something that's laughable, but it's actually true.
Mm-hmm.
And so this is very important information. This is almost like a public service announcement type information versus a fun, engaging live. And I really hope that you guys are listening to this. You go back, talk to your parents about where their money is, talk to your kids about what they're going to do with their money when they get older, or if they are adult children, what they're doing with their money right now. Because as we see in this next slide, we're going to see the difference in, where your money can be versus in certain types of investments.
Right. Yeah. So what this slide is showing, we have on the screen, is a slide of the general, basically it's S&P 500, but basically general the stock market relative to interest rates. Right. And so it starts in 1930. It starts in 1930 and goes through, I think it's like 2017 or so. It's a comparative chart, right? So the far left, from 1930 up to about 1970, 1980, interest rates and the stock market kind of went in the same path. They both generally went up. The market outperformed interest rates by about, I don't know, 5 or 10%, give or take. But they generally went up together. right? The market outperformed interest rates, but they generally went up. It was about 1970, 1980 where there was a split, right? So the market kind of turned over. Interest rates shot up to the roof. Now, I don't know the historical. I don't know why. Something happened, I guess, in history why this happened. I don't know if it was oil, I don't know if it was war. Something happened where there was a split between the correlation between interest rates and the market.
Oh, 1970? Is that 1971?
Yeah, 1971.
That's when they no longer backed the dollar by gold. So that's when the dollar started to take on quote, quote, intrinsic value. And there was no precious metal backing. And the market took a huge crash because no one knew what to do with money. So they moved to a lot of cash positions. And after people recovered and got their minds right, they realized the market was going to kill anywhere else they can make money. Like most of America went back to the market in droves. So that was that gap.
Yeah, because before 1971, the market outperformed interest rates. So yeah, they kind of went back to that mentality. But looking at this now, you see 1980, just like in the other charts, interest rates were at their all-time high. And then since 1980, the market has absolutely crashed. The interest rates have absolutely crashed. The interest rates are down about 90% since 1980. Comparatively, the market is up over 1,200% since 1980. So I'm gonna say that again. Interest rates are down 98% since 1980. The stock market is up over 1,200, almost 1,300% in that same 40-year time frame since 1980. And so what this shows is that there's been as the other chart showed, there's just been a continuously precipitous drop in rates as the stock market has absolutely shot through the roof. And again, if your money has not been in the market in any way, shape, or form, you've missed out on a almost 1,300% gain in the market. While at the same time, interest rates were losing 2.5% per year. So, I mean, as Brent said, I think this is probably our most important live ever because, as Brent said, most people's money are in these savings accounts. And what we're showing, we always say, oh, they're bad investments. We're showing the historical measure of it and showing that since 1940, you've been losing 2.5% per year, while the market is up almost 1,300% in that same amount of time.
Think about this for everybody watching. We're not saying, jump into the market, get super aggressive. We're not saying go out and buy real estate tomorrow. This is the education in Investing Education Academy, because the education right now is how you determine your next steps. And I know some people are listening, and I'm driving this hard home because if we're not committed to driving this point home to you all, as a people, we're going to continue to lose. And for all you all who think, well, there's nothing else to do, there are options out there. And if you want to join Investing Education Academy, cool. If you want to join a mastermind group going on locally, if you want to join an investment club somewhere else, cool. Like, that's fine. But you have to change if you're in a savings account. You have to change if you're buying CDs. I hear about grandparents and parents buying their children bonds at the bank when they're born, thinking that this is some heroic thing. You're hurting your kids, your grandkids. And no one's ever said it to you like this. So you've continued to think you were a hero. And we're telling you, we admire what you're doing. We think, it's great to even want to save for your grandkids or your kids or yourself, but do it the right way. And, everybody, again, you have your way of doing it. We're not saying we're right, but these are numbers. These are hard
facts, and they're undeniable.
Yeah, you can fact check this.
Yeah,
so
right.
Anybody watching and whomever you want to share this with tomorrow, and we've done this challenge before. We actually should do a challenge, Leon. We should totally create a challenge. We should do an interest rate challenge. But we actually implore all of you all listening to the podcast, no matter when you're listening to it, if it's a year later and you're listening back, if you're revisiting this live, call your bank tomorrow. Go on the website right now. Go on the website tomorrow. If you have a checking account, check what your interest rate is on your checking account. It probably isn't one. And then it's probably going to have fees associated to it, depending on the checking account. So now you're paying the bank to take your money and go loan it to other people and make money and then charge you for it. Mm-hmm. You're being charged to start their business. So I'm going to say that again. The bank some banks, not all banks, some banks are charging you money to go and loan other people money to buy a house, to start a business, to get a boat, to buy a motorcycle, to fund their children's education, to help their parents, to pay for a health issue, whatever it might be, just to have money to spend, to go on vacation. And they're giving you nothing, and they're telling you that you owe them money.
Mm-hmm.
And we're happy with this. Some people are happy about that. And that's why we're saying this probably is the least sexy, most important live that we are going to do so far. To me, in my heart, like it is. And
I agree.
Again, that's why I'm saying it like, and Beverly says, say it again. It's, I'm gonna say it again. The way we've been engineered to think, not just by our parents, but by society, is keep giving your money to the banks, because these banks are giving money back to the Fed when they are paying taxes, when they're loaning money from them. So the Fed wants banks in operation, right? Because they also, banks are the really the arm to our society. And they lend money, like they keep money in circulation. And so we are, as bank savers, those of you, because it's not me. So those of you who are bank savers, what you're doing, for everyone who asks, please share this with somebody. You are putting your money in the bank, meaning you are giving a business money to continue growing, and they are charging you for helping them grow. And you are saying, okay, thank you for it, keeping my money here and charging me for it. And no, you don't even have to keep pace with inflation, because I'm okay losing money all day.
Right.
And that's what's happening. I mean, I would love to tell you a different way and make it, a nicer story. But if I do, you might not change. So some of you all probably like, that jerk. Some of you all are probably thinking, you know what? I'm glad he said it like that. And for those of you all who have small children, especially, and I hear it all the time, oh, let's go to the bank and set up a savings account for your future. You are erasing their future the second you set up that savings account. And you don't even know it. So just let it sit in. That's that pregnant pause. We're not saying this to be insulting. We wish someone would have said this to us when we were young. I mean, luckily, Leon and I got into investing very early, but we could have done more. And I've had a rocky life. Like, people who know me will tell you, I've had several surgeries economically. I've had highs and lows, but I'm figuring it out again. And I'm in a space where I will never go back to a broken mentality as it relates to my money. My money is my employee. That's it. And if it's not working for me, it's because I'm a bad employer. Yep. And I'm not blaming it on anybody else but myself. What are you doing with your money? If you listen to this live, if you shared this live, and you still went back to putting your money in a savings account, and many of us do direct deposit, what does direct deposit do? It guarantees that this bank is going to get our money that we're probably never going to follow up on and put it in the proper investment, because it's so convenient. So if that's the case, I will openly hold your money for you and give you nothing and charge you for it. And over 10 years, you can build my empire, because that's what's happening with the banks. Most banks, not all banks, most banks.
Yeah, I mean, savings accounts are essentially interest-free loans that you're giving to a bank, and they're giving you nothing for it. They're using that money to, as Brent said, grow their business, earn profits, and they're paying you nothing for it. And again, you're losing money, actually, because inflation is 2 to 3% per year. During the time of COVID, it's actually more like 5 to 10%. So you're losing money every day, and you're helping to grow another person's business and getting nothing for it. So that's what savings accounts right now are. And again, we're not saying don't have rainy day funds. We're not saying don't have emergency funds. We all have to have that. We're saying your long-term investments should not be in savings accounts.
Yeah, and Chris Haas, let me tell you, Chris Haas is an amazing electrician. And also he owns his business. So if everybody on here is like, you know what, as long as Chris gives me my money back, we can fund his business. Maybe at least we become investors. And we say that and we smile like it's a joke, but it's really not. If you want to look up Haas & Sons Electric, you can Google it. And honestly, if we spent more time thinking about, okay, well, who has a successful business, and maybe we can lend our, discretionary funds to them, at least we're getting a higher rate of return than what we're getting in the bank, and we're building community businesses. If you see, again, if you set up a lemonade stand in your neighborhood once a week, you probably will yield a higher rate of return at the end of the year than you'll get at your bank as an adult.
Mhm.
And so we're not even talking about the people that just go out and spend money on frivolous things like, you know, I was about to say something, Leon, but I know you're like, it's not frivolous. It's
Yeah,
so,
right.
as you catch yourself, I quote myself, but this is one of the most important discussions we're really having, and that's why I'm prolonging it, because I'm hoping you all spend some time sharing it. And I see my sister in here. She's like, oh my gosh, like the truth is real. And Lene said the truth will set you free. And I normally never read responses. If anybody watches, I never read responses. I normally respond to them, but I'm reading these because it's true. You know, interest rates are a joke, Chris says. They invest your money and they make money giving you pennies. Most of the time, it's not even pennies. They charge you.
Mhm.
And every time we do something wrong and we get hit with an overdraft fee, literally that overdraft fee can wipe out what could have possibly been those pennies Chris is talking about altogether. And when Lene, Lene said, we gave her confirmation today, I'm glad. And that's why we're sitting here talking a little longer than what we need to talk, because emotionally, now that you saw the facts, you saw the graphs, we didn't make those up. You go the source for those. I can tell you if anybody wants to look this information up. Here's
They're on the charts.
Yeah, so I'm about to go back to the chart.
Go bank rates.
Yep, go bank rates. And I used to follow bank rates every day. And so, I know some banks have application fees. So when you apply for certain loans, they may actually charge you a fee. So just understand there are other things you could do with your money. And we can continue on, Leon. I think we went.
Yeah, got one. Just the last slide. And so so that's Brent was saying, like somebody said, they pay us pennies. It's not even pennies because again, inflation eats those pennies.
Yeah,
so
we're paying them.
You get those pennies, but inflation again 2-3% per year. They're paying you 0.05. There is no. You're actually losing money. So this, like I said, I think this is our most important podcast, our most important live, because it affects all of us. I mean, all of us have some sort of interest-bearing account, checking, savings, CD, credit union, something. And we're just showing that, again, for the last 40 years, they've been horrible, horrible investments for long-term money. And the Federal Reserve has said they're not raising rates for the foreseeable future. And even if they did, the Fed typically raises rates, like the Fed typically raises rates 0.25% when they do raise rates. 50, what is called 25 basis points. If they do a 50 basis points raise, that's a huge deal. So think about it. If the Fed raised rates 50 basis points tomorrow, that would take interest rates up to 0.55. So you'd be at half of 1%. Half of 1% for an entire year. I mean, you're still not getting any money. So, interest rates are a complete joke. And as Brent said, we're basically being ripped off because we're funding banks. They're making money and giving us nothing for it. So,
and we're paying them. That's the worst part. And I want that to sink in so badly. When we have our money, and this is in Investing Education Academy, let me tell you what happened one time. One of our members, from just having a shift in mindset and understanding where money can be, went to a store, went to Costco, saw a line for toilet paper and thought, I don't want to be here. I'm not standing in line, and left. But because they had a different mindset, because their minds were just slightly different, they went home, pulled money out of their savings account and invested it in Costco. Since the day they bought Costco, they're up over 25% on that investment, just because they're like talking about investing isn't a foreign thing to them anymore. They made 25 to 50 years worth of interest in less than 4 months. So, as it would be at a bank. So let me say it again for some people who probably didn't digest that. From going to the store, realizing it's a long line, people must frequent this store. And we're going to give you our stock picks in 2 seconds. I see some people asking about the stock picks. When they left, they thought, we always talk about owning what we do, looking for investment opportunities. It wasn't some, analysis that was done running Monte Carlo reports and regression analysis. They just saw a long line at a store that's been there for a while, that has proven to be a staple. They went home, pulled money out of their savings account because they realized, I'm not doing anything with the savings account, invested their money, and receive over 25% rate of return in less than 3 to 4 months, just making a smart decision. Because investing isn't foreign to them, and they know that savings account is the enemy. And my children don't have savings accounts. I know people always say, well, what do your kids do? When birthdays and Christmas run around, they don't run to the store and go shopping. We're not spending a lot of time wasting it on food. We're not spending a lot of time wasting it on clothes. We ask family for clothes, and I'm happy to say that on being recorded, because the money we save there, we opened up their investment accounts when they were 2 years old, really 1, and we had them putting money in their checking account so they can move the money to their investment account. That's the only reason they have a checking account. And my daughter at age 8, if we have money in that account, she's mad. She's like, we could be doing better. And so you can have your children have a different life, and they have enough now at age 8 and 4 that if they were 16, they could buy their own car. I don't have to help. I don't have to do anything. They could buy their own car. By the time they get to 2021, they're going to have money for their first home. I have not put a dime of my own money in either one of their accounts. It's all Christmas and birthday monies. And for parents who, have these kids that are geniuses and they take them out when they get A's to go shopping and buy things, you are teaching your kids to be consumers, and it is going to hurt them in the long run. And, we can talk about what's right, wrong, but then those of you all who are like, oh, this is great, let's put all our money in a savings account, that's the wrong lesson too. We have to show, if they're starting a shoe sign business, or if they're working with Haas & Sons Electric, if they're working with Attorney Beverly Winstead and they're filing papers at 6, 7, these are the things we need to teach our kids. And last thing before, soapbox, Attorney Beverly Winstead has her niece on her board of advisors for a law firm at age, I think, 7. And it's a paid board. These are things we need to be doing. I'm on the board, and it's like I'm sitting next to a 7-year-old in our meeting, and this is the coolest thing in the world. Or we're doing a Zoom call, and there's a 7-year-old digesting everything. A 7-year-old getting the mentality to say, I'm a board member of a law firm. Mm-hmm. These are things we need to be doing. But conversely, we're like, oh, this isn't for you. You're too young. Oh, my kids won't understand that, so they shouldn't be involved. Oh, well, savings account is easy. It's safe. So we're going to keep doing it. We're okay. But then when the separation happens and we get older and our kids grow up, and all of a sudden those kids are bougie, or those kids are stuck up, or those kids this, because you made bad decisions when you were younger for your children.
Right.
Don't put that on other people. You have the moment right now today to change your future and your children's future. If you choose to continue teaching your kids and yourself bad habits, this is, Leon and I can say with a good conscience, we tried.
Yep. All right, hey, throw up last slide.
This is the last slide.
No, there should be one more. You had it was up there.
Takeaways, right?
Yeah.
Oh, you
Nothing's up yet. Oh no.
Oh, I wasn't doing the screen share. I was reading it. Cool. I'll say for everybody listening to the podcast, right now we have the key takeaways for today. And as soon as we're done with the key takeaways, we are going to give you our stock picks.
Right. So key takeaways. So again, this was on interest rates. We're talking about why they're bad and how they've been a horrible investment for the last 40 years. So interest rates and interest-bearing asset and account returns, can say that twice, have declined 98% over the last 40 years. So that speaks for itself. Interest rates are down 98% over the last 40 years. What that translate into, to kind of be a little more digestible, is that on average per year, your interest rate bearing account is losing 2.5% per year. So the rate of return you're getting every year is going down by 2.5%. That is the exact opposite of what investing is supposed to be. You're not supposed to lose return, you're supposed to gain return. Conversely, in that same 40-year time, the stock market is up 1,219% over that same 40 years. So if you have not been in the stock market over the last 40 years and you've had all your money in the savings account, you've lost 90% return on average return per year, and you've missed out on 1,219% return that you could have gotten. I mean, just massive returns. And this goes back to the ROI and wealth gap that Brent and I talked about before. The reason the gap is so large is numbers like this. Most African Americans and people of color have their money in savings checking accounts. As it is shown over the last 40 years, per year, you're losing 2.5% return, whereas everybody else that has their money in the stock market has gained 1,219%. This is why that gap is 60 years apart. African Americans just caught up to white wealth as it was back in 1962 for these exact reasons here. And last point, just what we've been saying, please move long-term investments out of interest-bearing accounts and assets into things like the stock market, real estate, or business, things that actually give you a larger return than inflation.
Yep, and we want to say traditional interest-bearing, right? Because it's those banks, the CDs, the bonds, and I know there's a lot of people out there. We can go into 529 plans and 401ks and what they really do, mutual funds versus ETFs. We can do that all day, and we do that inside Investing Education Academy. Like the conversations you see here is just one layer. Like inside of our platform, the reason why we had 81% membership growth in August is because people are making money and changing their lives. And if nothing else, their mentalities will never go back to what they are. And habits are hard to break. And, we're going to have Sal Scatino at some point come on, and we're going to talk about regression to the mean. And I'll stop there, but just understand there's benefits to being in communities that are talking about investing on a regular basis to demystify the stock market, and entrepreneurship, real estate, and what we just recently learned, tennis shoe flipping. And private equity deals, all these things, we just don't know about them. And I had an investment that had returned or appreciated 233%. I didn't even know because I didn't know how to look it up. And I learned it inside Investing Education Academy as one of the co-founders. I'm still learning from it. So I really hope you all join something, but today's the day. Call tomorrow, check with your banks, ask what the interest rate is, and just think about that. Think about how long it's going to take your money to grow versus, even if it's a lot of money, you can have a lot more if you were in the right investments.
Right.
All right, Leon, you want to start off with your picks or you want me to start off?
No, I'll go. So my pick today is something you probably all know, is JP Morgan. It's a bank.
I know why.
JP Morgan, there's two reasons. So the reason I picked JP Morgan is, I don't know if anybody's following the banks or not, but the banks have been taking a beating. And one of the reasons is this topic today, is interest rates, right? So as we said, when we take out loans from banks, we have to pay an interest rate, right? And the higher that rate, the more money the banks make. Well, as we say today, and as we saw in the last 40 years, interest rates have been dropping. And so banks, not all banks, but some banks, and JP Morgan is actually not, they're not a big player in loans, but they do have some. But one of the reasons banks are down is because the return they're getting from interest rates are historically low. I mean, rates are damn near zero right now. So they're and also what something's called loan losses. So banks lend out loans, but right now because of COVID, a lot of businesses have shut down or really struggling, and they're gonna have to write off a lot of bad loans. So banks are kind of not as bad, but they're kind of in the place where like hospitality is. They've taken what we call a COVID hit, just because of the state of the economy. But JP Morgan, the reason I like them is, one, they're not huge into the loan business like Wells Fargo or Bank of America. They're more into the investment banking side. So like advising companies on mergers and things like taking companies public, things like that, money management, stuff like that, versus actual loans. So that's one reason I like them. And two, they pay a seriously nice dividend. So they pay 3.75% yield per year. Now, remember, as we just said, banks right now, savings accounts are paying 0.05% on average interest. JP Morgan is paying me 3.75% per year. So I mean, I'm getting.
Hold on, Leon, real quick. Did you say paying me?
Paying me. Yeah, I mean, yeah, they're paying me. It's all about me, right? It's my pick. So, but right. Yeah, they're paying 3.75% interest dividend yield per year. So again, no matter what the stock does, up, down, or indifferent, you'll make at least 3.75% per year, whatever on the amount you invested in JP Morgan. I just want to make another point how big they are. So their revenue last year was $115 billion. Revenue, $150 billion, and they netted $36 billion. So we're talking about a company that has a wicked strong balance sheet, and they have crazy cash flow and crazy cash reserves. So this is the company, and as I said, banks are taking a hit and I like that because they're down, so I'm getting them cheaper. I believe what was it at the peak? It was at Brent, go to the 1
5 year or 1 year.
Yeah, 1 year. You see what the peak was? So their peak was what, 140?
138, 140.
Yeah, so 140. So, and it's now at 96. So you see the huge discount that it's trading at right now relative to where it was. And their PE, I believe, for people that have heard us talk before about that, I believe their PE is like 12.
12.7.
Yeah, like, so yeah, real low, 12. And remember the PE right now, I think in the S&P 500 is like 20 to 25. So it's really under the general market, which is also good. So that's why I picked Bank of America.
JP Morgan.
Sorry, JP Morgan. That's why I picked JP Morgan. Their ticker symbol is JPM, and their 3-year average sales are about 10% per year, and their 3-year average profits are about 20% per year. So solid sales, solid profits, huge amounts of cash, pay a 3.75% dividend yield, and it's a depressed stock and kind of a depressed sector right now because of COVID. So once COVID's over, like everything else, these things will recover. But yeah, so JP Morgan is my pick.
All right. And so for anybody who's watching again, and we're talking about banks versus just a dividend paying stock. If you were just to put your money with a dividend paying stock, you're talking about getting 3.74% dividend yield on the investment, right? So you still have the upside potential and downside risk of the stock price being a little bit volatile. But you have this dividend coming in paying 3.74%, which means that your money will double roughly every 18 years versus those who want to feel safe and keep their money at a bank right now, and your money's going to double every 130 or 40 years. So, okay, I'm going to say that again. For those of you all who want to feel safe and keep your money and have your children's money in a savings account, your money and their money will double every 114 years, maybe every 72 years if things get better. So in an investment like this, you have the possibility of your money doubling every 18 years. So just wanted to point that out.
And just what that's one that thing you said about losses. So, and also think that, this is paying a 3.74, 3.75% interest rate. So what that means also is if JP Morgan has to lose more than 3.75% in a year for you to lose money, right? So your downside is actually kind of cushioned by the interest rate. If it went down 4% in a year, okay, you would actually lose 1% because you still have that, or a little less than 1% because you have that 3% yield. So as I like to say, the dividends pad gains and cushion losses, because again, if it dropped 3%, you would still actually come out ahead and make 0.74, 0.75% on your money. So interest rates are also help gains and help losses also. And
when Leon says drop, he means the stock price.
Yeah, the stock price. When the stock price dropped, yeah.
The stock price. So you have the cushion of the stock price if it goes down, and you have the bonus if the stock price goes up.
Yep.
All right. So that is Leon's pick. My pick today is a little bit fun. I figure everybody's at home, and we talked about stay-at-home stocks. Also, for anybody listening who heard Leon mention PE ratios, we actually have a discussion. Just go back to IEApodcast.com, and you can scroll through and see the episode we did on PE ratios if you want to know more about what they are and how they work. But for those of you all who are like, Brent, tell us what you got. Let me make sure I have it the right way. I chose Activision Blizzard Inc. So this is a gaming company, and they make some of the games that we love. Well, I actually don't play video games, but I love the fact that other people do. So it is Call of Duty, Candy Crush, World of Warfare. These are games that many of us play. We know people who play them. It makes sense. Everybody's at home. They're trying to figure out what to do to entertain themselves. Video game sales are going through the roof. And some of these makers are making a killing. The reason I like Activision, and let me actually pull up their 5-year chart. And anybody trying to look them up, the ticker symbol or what they trade on the exchange is under ATVI. ATVI, again, if anybody's wondering. They provide a service where they're creating a gaming platform for professional gamers. And they watch a lot of the viewership happens on platforms like Twitch. So Activision Blizzard is essentially getting into the entertainment field beyond just playing games. You now can buy a franchise. You can buy like a sports team that represent a certain state. And franchise owners include everyone from Robert Kraft, who's the owner of the Patriots. He has a team. He paid $20 million, and he now has an active Activision Blizzard gaming team. And the gaming teams in roughly 2018 were about $20 million per team. They're already up to $30 million per team. And there are kids being recruited out of high school, college, junior high school to be brand represented, brand ambassadors for these gaming sports teams in competition. I mean, they're making more than many adults day to day. This is also one of those places where, you know, being here in these conversations, you're probably, maybe some of you all already knew this, some of you all don't. You know, this company has revenue of like $6.5 billion. And you never thought that gaming was going into the space of franchising. They're franchising teams now. And this is new. So we're still on the beginning of the curve for investing in this type of platform and type of industry. So gaming industry, very real. They're a leader with esports in the esports growth sector. This is considered esports growth. And let me have some stats. The franchise is 20 million a pop, now 30 million a pop. They have 1.1 million viewers on Amazon. They have a deal with Amazon that actually runs their games live, and they're getting eyes in the point of 1.1 million, which means they're going to get killer advertising dollars in the future. Then also they have an exclusive deal with Google, and that deal is going to, again, it's going to be a platform for them to show their sporting events to the masses. Revenue in 2015 was 4.6 billion. Revenue 2019, 6.5. And I'm pretty sure that the revenue in 2020 is going to beat what it was today. Shares of Activision Blizzard over the last 5 years have increased 153%. I'm going to say that again. The shares have increased in value, the stock price, 153% over the last 5 years. And they're just getting to the place where they're introducing the franchising into this. And as we know with the sports like football, basketball, these franchises, even when they're hurt, they figure out a way to make money. And doing it virtual is one of the best things you can do. And the gaming platforms are designed for it. And it's growing with the millennial population of roughly 72 million, the population behind them coming into 72 million people, millennials in existence. And then you have to think the group coming after them is going to be about 68 million people. And they're all growing up digitally designed to game. So I like them for that reason. And they pay a dividend. It's a small dividend.
How much is the dividend?
It was 0.5.
Oh, okay.
But
I didn't know about that's news to me, the franchises. I didn't know about that.
Oh, that's why I like them. Like, you know, that's what's huge. I mean, also too, franchising gives you the opportunity to get concession money. It gives you the opportunity to get marketing dollars. It's so many things that are going to come out. And also they're moving into like the user data space. So they're just analyzing, and video games are getting very sophisticated in regards to how they're analyzing our behavior patterns, eye movement, and then they're using these for simulators. So many of these gaming systems or gaming companies are being approached by like NASA because they want them to help build simulators. So it's getting much bigger than just a gaming system. And with VR and, you know, being the next like wave of technology, yeah, gaming is going to become incredible.
Yeah, definitely.
They're using it to train police on unconscious bias.
Okay.
So it's
like a whole other market then, yeah. Oh
my gosh, it's so real. So you heard it here first. It's currently trading $80.95, and it pays a 0.5% dividend, which still beats the bank.
Yeah, right.
So we hope everything today made sense. You were able to digest it. You can use the information to, you know, go out and have a different kind of life, because that's the win for us, because we're not doing it just to gain people. We're doing it really to help people. Also, of course, if you want to join Investing in Education Academy, we have conversations like this and more inside of the platform, because there were two very important IPOs today. I don't know if you knew about them. We invested in them. I hope you did. So, you know, just think about what you're doing with your money. be smart, teach your children. If you're doing it already, great. If you're not, teach them the right way. And also talk to your parents, because honestly, it's still time for them to improve what's going to be their retirement. It's still time for them to grow their money. And it's a conversation we need to have with our families. Thank you for being with us. Leon, you have anything?
Nope, that's it. Just again, hammer it home. Interest-bearing accounts are horrible, horrible investments. They're okay for rainy day funds, but if your money, if you have long-term investments, please get them out of interest-bearing accounts. They're down 98% in 40 years, and they're not going up anytime soon, as the Federal Reserve has said. So entrepreneurship, stocks, reselling sneakers, what have you, please, we got to put our money to higher interest-bearing or higher return investments.
Yep. Everybody have a great day, and we will see you all next Wednesday. Again, www.IEAmembers.com. We hope you join today. If not, this weekend's coming up. Have a great day.